Welcome to Level 3, Lesson 7. My name is RIA the Trader from TradingWing.net. In this lesson, you will learn about the critical differences between technical and market indicators. Please note, there will be some terms used in this lesson that will be explained and defined in a later lesson. As of this lesson, they are not important. So let's get started. Before breaking down the difference between technical indicators and market indicators, it is important to understand what indicators generally are. Indicators are mathematical calculations that are displayed visually on your price chart. Because they are displayed visually, indicators fall under the umbrella of technical analysis. In fact, indicators are used by almost all technical analysts and traders. When referring to indicators, it is important to note the two main styles of indicators, known as leading indicators and lagging indicators. Leading indicators aim to forecast what prices will do in the future. They also measure if a stock is either oversold or overbought and work really well in sideways markets. These are markets that are neither bullish nor bearish. A common con that is brought up when referring to leading indicators is that they aim to predict the future, a future filled with uncertainty. This uncertainty leads to higher risk, and therefore, leading indicators are higher risk indicators. The next style of indicator is known as lagging indicators. These indicators display what prices have already done. Therefore, they are not used to forecast what prices will do in the future. Instead, they measure if a stock is doing well within an overall long-term trend. Because they do not aim to predict the future, lagging indicators are considered lower risk indicators. Here are a few examples of indicators. Now that you have a better understanding of what indicators generally are and the styles associated with them, it is now important to break down the two types of indicators. The first type are known as technical indicators, better known as technicals. Technicals use historical data such as price, volume, and open interest to forecast market movements. This type of indicator is made for the disciplined trader. This is an individual who is not greedy. Instead, they align their theory or hypothesis with technical indicators. If they match, they proceed with the trade. If they do not match, they stop the trade. Technical indicators are also universally used, so therefore they're used in stocks, futures, commodities, currencies, and so on. Now let's look at the types of technical indicators. There are two main types of technical indicators. The first are known as overlays. These are indicators that are drawn on the same graph as your price chart. For example, Bollinger Bands. Oscillators, on the other hand, are indicators that swing between a minimum and a maximum value and are drawn on a separate graph either above or below your price chart. For example, MACD. Looking back at the examples that I provided earlier, we can note that the first graph that we see has overlay indicators, whereas the next three have oscillator indicators on them. The second type of indicators are known as market indicators. These are a quantitative tool used to forecast market movements. They do fall under the subsection of technical indicators, however, they are fundamentally different, and here is why. Market indicators are calculated by using statistical formulas on a set of data points to create different formulas or ratios. To put it into simple terms, technical indicators use data from a single security, whereas market indicators use data from multiple securities or stocks. Market indicators are plotted on separate charts and graphs. Similarly to technical indicators, market indicators also have types. The first type of market indicator is known as market breadth. Market breadth views the number of stocks contributing to the move in an index or stock exchange. For example, the advance decline line. The next type of market indicator is known as moving average. This provides the average price of a stock or security over a certain period or time frame. Moving averages are displayed visually using a single line and are known as lagging indicators. They provide price movements that have already happened. The third type of market indicator is known as on-balance volume, which is a momentum-based indicator that uses trading volume to forecast changes in stock price. The last type of market indicator is known as market sentiment, or new high/new low. This refers to the overall trader sentiment. It compares the number of traders who expect a bullish movement and ones who expect a bearish movement. If you do not understand any of the terminology used today, it will be explained in a later lesson. And that concludes this lesson.